topic 3 is a good practical topic. Okay, good practical topic on government-related financial requirements. Whoa, buddy. And this is one, if you were to run your own business, or if you were to be, just to give an appreciation for the importance of this issue, because a lot of people, particularly in business when they start off, do not give a good appreciation to this section. That is that they owe money to the federal government that they collect on behalf of the federal government. And if you don't pay it, the federal government doesn't like it, and they will fine you for it in all kinds of wonderful ways. So tonight, I wanted to take a half hour to kind of review this section and give you an opportunity to look at it here later on in the week. So that's what we're going to do tonight. So effectively, we're looking at government-related financial requirements and source deductions. That's what we call this stuff. Whenever you get your pay stub, a certain amount of money is pulled off as source deductions. Your employer is responsible for getting it to the federal government. And so if the employer, and if you take the point of view of an employer, you are going to be responsible for remitting it to the government on a monthly basis. If we think about it, all employers are required to do this because all employees will be responsible for paying taxes or be responsible towards paying the EI program, the contributions. And the EI program, we got to think about EI as an insurance program. It's not a tax. You're paying money into that as an employee. You're paying money into that. In the event you got laid off, you will be able to avail of employment insurance. That's basically how EI works. The thing is that you make a contribution to it and your employer makes a contribution to it. And we'll talk about that a little bit more. In terms of things like taxation, you pay the tax. The employer doesn't pay that. But again, you're also responsible for paying Canada pension plan benefits. And a pension plan, for someone like you, Harrison, who doesn't have a pension plan, when you're young, it doesn't really click with you. As you get older, it starts to click with you. Effectively, what's going to happen is when you retire, you will have no income anymore. Without a pension plan, you will have no income and you will starve. So what the government has done back in the 60s, they decided to create a federally sponsored program that ensures that every working Canadian will be able to avail of a pension when they retire. And you're paying for it as you move along through your working career. You're contributing to that pension so that when you turn 65, you'll be able to draw down it. So basically, it's a savings. It's not a tax. It's a savings program that you will be able to draw from. And we're going to take a look at that. So as an employer, then, you're responsible for those things, and you're responsible to pay the salaries and wages of people. You're responsible for making sure that the tips are paid. So if you're working in a restaurant and you are getting tips and someone puts it into the machine, the little Interact machine, when you put the tip, that tip has to go to the employee. That is not the organization's money. They're responsible. The employer is responsible for making sure it gets paid out to the employees. Bonuses and vacation pay. Again, vacation pay is an interesting one because you earn vacation pay every day you work. You earn vacation pay, which will give you at least 2 weeks off. They draw money out of money out of the employers. The employer pays for that. Money out of the employers will go towards vacation pay. And you also need to consider other benefits that the employer might pay, such as health and dental and these sorts of things. What we're interested in is what the government wants, okay? So the Canada Revenue Agency, or Revenue Canada, or the tax man, whatever you want to call them, they're the people who act on behalf of the federal government to do those tasks with employers. So what do you need to do? If you're setting up as an employer, if you're going to hire people, or if you're working as an employer, the very, very, very first thing you need to do is get a business number with the federal government. And that's pretty easily done. All this stuff is available online now. So for all companies that are responsible for remitting, even if you're hiring a babysitter to manage your children, and you're paying that babysitter wages, you need a business number. So all companies or people who pay salaries basically are required to get a business number and remit on a monthly basis the monies that they collect, that you collect on behalf of the employee to the federal government. You go in on their website, this website right here, that allows you to register to get a business number. And a business number is just a series of digits, no different than a social insurance number for your business, okay? And basically, when you give that information to the federal government, you're going to give them your address of your business, what province you're operating in, because that makes a difference with regards to how much tax is collected, what the business's name is, and the owners. And as I say, this is a website that you go to. You can sign up, very easy to do, not complicated. They even got a little director there to show you how to do it. So that's the first thing. As a business, you get a business number. Once you got a business number, then you're going to have employees, and those employees are working for you. Your employer, where you're sitting there now, your employer has to do all this. And here are the things that the employer needs to do. The employer has to pay into or contribute to the Canada Pension Plan, as do you. Your employer has to collect federal and provincial tax on the federal government's behalf. The province kind of piggybacks on with the federal government. Your employer has to collect your portion of taxes and pay it to the government. So that way you're not getting a big tax bill at the end of the year. They draw it out as you go through your work year. You pay taxes through your employer, and your employer then sends it off to the federal government. Your employer is responsible for making sure that you contribute, you as the employee, and they contribute as well to the insurance program for employment called EI. So effectively, you pay a portion of that, the employer pays a portion of it. And the employer is also responsible for other things that are not called tax, but they're important benefits that you get. One is called workers' compensation. Workers' compensation is provincial, but it still comes out of your check. It comes out of the employer's, not your check. The employer pays the bill for workers' compensation. Depending on the type of industry, Greg, you're probably in a fairly risky business. Your employer is paying a fair dollar to the workers' compensation organization, Newfoundland Workplace Health and Safety Commission. They're paying money every 2 weeks. They're contributing money to the commission on your behalf. Effectively, they're paying the insurance on you. That means that if you ever had an accident at work, that meant that you were either hurt or, God forbid, killed, that insurance plan, the Newfoundland Workers' Compensation Commission, would pay your family benefits. Or if you were hurt, more likely you would be hurt at work. And if you're hurt, that organization, the Newfoundland Workplace Health and Safety Commission, will fund your rehabilitation. So effectively, the thing is, the employer pays that bill. You get the benefit if you're hurt. And the wonderful thing is that the employer has to pay this, not you. What it does do, though, what you give up in return for that is you can't sue your employer, or in most cases, you can't sue your employer. When the companies go and buy stuff too, they also are responsible for something called the HST, which is the harmonized sales tax that they're responsible. If a company fails to pay these things, Canada Revenue Agency, federal government, will garnish wages or other income sources, seize and sell company assets. So they're not fooling around. They will, if you don't pay it as an employee, or if the employer doesn't pay it, they will come and get it from you. So here's an example of a pay stub. This is just like any of us would get a pay stub. It would have all the information for the pay. But you'll notice that deductions are here, okay? Deductions. So you make an amount of money, a gross income, and from your gross income, deductions are taken away. And you will see that in this particular instance, the Canada Pension Plan, $72 employment insurance, $25, federal tax, $141, income tax, $70. That gets deducted from your check, which gives you a net pay at the end. Now, so you're contributing a portion of money, portion of your paycheck, to the Canada Pension Plan. You're contributing a portion of the money to the EI. You're contributing to income tax. And so all of these things you contribute to. Now, some of those your employer contributes to as well. A lot of people confuse these things with tax. CPP and EI are strictly not tax. They are benefits that you will avail of at some point in time. So how does it work from an employer's point of view? Well, first of all, we'll look at the Canada Pension Plan. The Canada Pension Plan, employers are responsible for deducting Canada Pension Plan from the checks or the payroll of employees. And the employee needs to be in a pensionable employment during the year. The employee is not considered to be disabled, and the employee is between 18 and 69 years old. So if the employee that the employer has employed falls into those categories, the employer has to collect pension. Now, here's how it works. The employer must contribute an amount equal to the Canada Pension Plan deducted from the employee remuneration. So let's just go back to this pay stub. In this particular instance, $71.98 was paid by the employee to the Canada Pension Plan. Well, what happens for every dollar that the employee contributes, the employer contributes as well. So in this particular instance, the employee put in $71.98 and the employer will put in $71.98. So the total, the $142, is the responsibility of the employer to pay to Canada Revenue Agency every single month. So Canada Pension, you pay it, the employer pays an equal amount, the employer sends it off to the Canada Pension Plan every single month. So for every dollar collected from you and every dollar, an equal amount is matched by the employer, and the employer is responsible for admitting that to the federal government. That's Canada Pension. Income tax. Now, the thing is with income tax, if we look at income tax, we'll go back to our little thing here. Income tax, there it is pulled out. And in this case, it's just broken in two, but these taxes, you, the employee, is the only one responsible for paying the tax. The employer doesn't pay your income tax. So out of your check, for $1 and contribute for every dollar, $1 gets sent to Revenue Canada. So that money, even though your employer pulls it out of your check, the employer doesn't contribute anything, but the employer's job is to remit it to Revenue Canada. It goes to the Canada Revenue Agency again every month. If the employer doesn't pay it every month, Revenue Canada will come down hard on them and fine them. So in order to figure out how much money they are required to deduct, because really it's an estimation. This is why we do our income taxes at the end of the year. The payroll basically estimates how much tax you're going to have to pay based on some issues that are described in this tax, in this website. So the employer estimates how much tax, they pay that tax, and at the end of the year, when you fill out your income tax form, all you're trying to do is to prove, whatever you want to call it, to rectify how much money you actually paid versus how much you actually owed. If you paid more than you owe, you get a tax refund. If you paid less than you owe, you got to pay money in. The payroll deduction, there's an online calculator for employers. If you click at this, you'll go to the online calculator. And for example, a bunch of stuff there. But if you say I accept, it will give you like a little working spreadsheet here where you can actually put the information in, where you live, all that sort of thing. I'm just going to fill it out halfway here now to do this. To tell how often you get paid, biweekly. Oh, and let's do that, and there, and next. So what all you do is type in how much you got paid. So in this particular instance, let's say you got paid $1,500. That was your paycheck, and the vacation pay, you calculate that at 4%. So that's $60. Okay, and then next, type that in, and it will figure out how much tax you're supposed to pay during the year, and it will figure out exactly how much money you have to pay the federal government, or take from some, if you're the employer, how much you have to pay to the federal government, and from the point of view of how much you need to take from someone's check every week in order to do this. So this is a pretty straightforward system that any employer can go into and figure out how much they need to deduct from someone's check. So it does all that for you. So income tax, you pay it. The next major deduction is employment insurance. And as I say, employment insurance is designed, it's an insurance program. So if you get laid off, or if your job disappears, you will get basically, here's round numbers, a year's employment insurance until you find a new job. You will have money. So how does this work? Well, you as an employee contribute $1, or for every $1 you contribute, your employer contributes $1.40. So for all the money that comes out of your check, in this particular instance here, for example, $25.04, your employer was responsible for paying 1.4 times that, so about $33. So your contribution is $1. The employer's contribution is $1.40 for a total of $2.40, and that money, the employer is responsible for submitting that to the federal government as well once a month. So these are the key federal government ones that come out of your paycheck, and you can see there's your contribution, there's the employer contribution, there's your contribution in the case of tax, there's your contribution, and there's the employer's contribution in the case of Canada Pension Plan. Those are the mandatory deductions that employers need to make for the purposes of the federal government and for the purposes of employment. So the employer has to do some work as the employer pays people's paychecks to withdraw money from the employee's check, but also to match or 1.4 times it in the case of employment insurance, and make sure that every month, in the middle of the month, 15th of the month, it has to be paid to the federal government. Now, so that's part of where your check goes, or how you, when you create a check, that's some of the money that is automatically owed to the federal government. Another thing that you never see on your paycheck is something called workers' compensation, because the employer is the only one that pays workers' compensation. So it's not on your pay stub. You will not see workers' compensation on your pay stub. But the way workers' compensation works is that every single industry has what's called a rating, okay? Certain industries, like fishing, is a very dangerous business. It has a high rating. In other words, the employer is responsible for paying an amount of money per $100 of payroll. That's around $3.49. I think it's somewhere around $3.50 or thereabouts. So the amount the employer pays towards this insurance program is really dependent on how dangerous the business is. A business like I'm in, my employer doesn't pay very much for me because I'm not in a dangerous business. So the more dangerous the business, the higher the workers' compensation premium is that the employer pays. So the employer pays $1 and they remit it to Workplace Newfoundland and Labrador. And that's done on a monthly basis. So employers are responsible for doing this too. And this is particularly important in heavy industry because you want to ensure that if you're hurt on the job, you will make sure that you won't run out of money. Your pay will continue. And this is the program that allows it to happen. The calculation, for example, I just have a calculation from an employer's point of view for workers' compensation. How much will it cost? Different industry pay different amounts. And there's a table. This is the 2021 I have here. You can see if we go to that, you can see different industries. I'll just quickly go to it. This is the different types of industries in Newfoundland and Labrador. So let's look at the oil and gas industry, Newfoundland and Labrador. If you work in the Newfoundland oil and gas, conventional oil or natural gas industry, the calculated rate is 63 cents premium per $100 of pay. So for every $100 of payroll that the oil and gas industry has, or the company that's involved in the oil and gas industry have, they have to pay 63 cents. If they're paying at $1 million, then they're going to pay $6,300. Okay? And you can see quarries and sand pits is $2.35, quite a bit more. So it's really based, the premium that you pay is really based on the safety record of the business. Now, certain businesses, companies who are proven safe, if we're all in the oil and gas industry and my business is much safer than the business you're in, my business will get a rebate on how much they pay. They'll get what's called a prime rating, meaning that the amount of money they actually have to pay is less than what's stated here. But workers' compensation is a great thing, and employers need to get their head around the type of business they're in and how much money they're going to have to pay in terms of a contribution is always based on $100 of payroll. So someone paying $50,000 in payroll with a rating of 94 would have to pay $470. Another remittance that companies need to do has nothing to do with payroll at all, but a very important one for businesses, and that is something called the harmonized sales tax. We're all familiar with the HST because we all pay it as consumers, but companies pay it as well. But the way that this taxation system works, since it's been brought in 2001, the way that, or 1991, I'm sorry, the way that it works is that a company only pays the HST on the difference between what they bought and what they paid. So let's assume that we're a business in the plywood making business. We make plywood. We buy the plywood for $10 and we pay tax on that. So as a 15% is the rate of tax. So we pay $1.50 in tax on that one sheet of plywood. We turn around and do something with that plywood. We cut it, we mill it, we make something out of it, and we sell it for $20. Well, when we sell it for $20, someone's going to pay us HST on it. And in fact, they'll pay us $3 in HST. That will collect $3 as we sell it, 15% on $20, $3. The way the system works is we paid $1.50 in tax when we bought the plywood, the raw material. We collect $3 when we sell. So what the business does, what a business has to do is to calculate how much they paid and how much they collected. They collected $3, they paid $1.50. 3 minus $1.50 is $1.50. So they only pay the difference between what they collected and what they paid. So it's what's called a value added tax. So companies only pay the amount that was value added. So is a type of a value added tax on consumption. The tax is placed on a product. And it was weird. It's gotten it's more complicated than any other one because not all products are rated the same. There are other types of products, for example, and again, you can do the little calculation on it. There are products that are not, we don't pay tax on. Groceries, for example. When you go to Sobeys, you do not pay tax on groceries. So it's what's called a zero rated product. So Sobeys got an interesting situation when they go to remit how much money they pay in sales tax because they might pay sales tax, but they don't collect it. So different types of products will have different tax rates applied to them, and companies need to consider it. But the basic calculation is always the same. That is, how much money did you pay in tax when you bought something? How much did you collect when you sold it? The difference between what you bought and paid, or the tax that you bought and paid, is what you have to remit to the government. The companies need to register for the sales tax, different than the business number that you pay for, that you could get for the purposes of payroll. HST gets put in place. You need a HST, And as I say, there are different types of products out there, taxable products, zero-rated products like groceries, or exempt products. So from a point of view of tradespeople, most products that tradespeople be involved in, so for example, if you're in carpentry, or if you're an electrician, or if you're in machining, you're going to buy raw material, and that raw material is going to have tax on it. So you go buy a sheet of steel, and it's $400, you're going to pay tax on that sheet of steel. When you sell that product at the back end of your store, you're going to collect HST on it at 15%. What you need to do is figure out how much you paid in tax, how much you collected in tax. The difference between the two is what you submit to the federal government. And depending on the type of business you are, we have, different, the tax system, the way the tax is applied is going to work differently. So most products are what are called taxable supplies. And, sale, new houses, rentals, leases, car repairs, soft drinks, clothing, advertising, taxis, legal and accounting services, franchises, hotel accommodation, barber and hairstyle. Generally, all those collect tax. But as I say, there's zero-rated ones too, such as basic groceries, where Sobeys might pay tax to get stuff delivered and that sort of thing, but they don't collect tax when they sell it. Agriculture products, farm livestock, fishery products, prescription drugs, medical devices, feminine hygiene products, exports that get sold abroad, transportation services. A lot of those are zero-rated. In other words, we don't collect tax, we just pay tax on the input. And we have exempt supplies that there's no, an exempt supply, we don't collect tax on it, nor do we pay any tax on it. And there's a bunch of them as well. Obviously, it gets a little bit finer than what we are for the purposes of here, but depending on the product we sell, how the taxation applies is going to be different. So effectively, the bottom line is with the HST is that companies need to charge the HST, especially if they're, if they're going to be able to be in business. You need to really collect the HST. You need to figure out how much you have to pay every month by taking how much you paid versus how much you collected. The difference between the two will be how much you have to pay. That has to be collected and paid monthly. Federal government don't like you not paying your bills on time, and they will fine you if you don't do it. And you have to file a GST and HST return. This is something that companies need to do. And again, this is where accountants do a lot of work, because that you're adding up all the stuff you bought during the year and all the stuff you sold during the year, and creating this tax return accordingly.